Okay, good evening. I'm glad Dragos is in the front row here because we got together last week and he was in unanimous agreement with every aspect of my plan. And so he'll be certainly there cheering us on. I know there might have been one or two small disagreements we have, but it's great to see you. Just share with your neighbors how compelling this plan is. Listen, I want to start, as you just said, I'm the new Chief Executive Officer of T-Mobile US. And I've been here long enough to know a few things, that certainly there's been a period of time here where you've been hearing, I'm sure, about the US business and how it's going to change. And some of the messages you hear today may sound familiar, and I'm cognizant of that. But I'm going to try to be very specific about what's different, and I'm going to be very clear about some of the issues that we're working on. And I'm very certain that in the coming months, you're going to see dramatic change in the business, because most of the variables that are required are in place. There's no overhanging event like there was with the AT&T transaction. There's no major missing components like a network modernization program that needs to be done. And we're in the factor of executing a number of things, including a very, very exciting coming together. With me, on my left, Braxton Carter, who will be the CFO of NewCo and is now the CFO and Vice Chairman of Metro PCS. We'll be talking to you about the financials of the company. We've been together since I started. As you've noticed, the week after I started was when we announced the transaction, and Braxton and I were together talking about NewCo and everything we've been doing since, subject to U.S. gun jumping rules being honored, have been about NewCo. And I'm very happy, and I think you'll see that the chemistry between us is such that we're a great partnership already. Neville over here on the right, you may or may not know that 2 weeks ago, upstaged most of us in this room, where Fierce Wireless magazine announced the 25 most influential people in the U.S. wireless industry. I will have you know that although I've been here for 2 months, I did not make it into the top 25, nor honorable mention. And well ahead, even the chairman of the FCC, which is probably not a good thing. Number 6 on that list, and the only CTO, was Neville. So if he's feeling any pressure, he'll have to show that. Now, I think your charts might be one out of sync with mine. But what I would like to do is talk to you first about the key messages of what we're going to talk about. A lot of these messages were covered by Renee, but I'll reinforce them. I want to start by telling you that I spent a tremendous amount of time thinking about several variables, including the challenger strategy. Starting with the time that I was negotiating with Tim and Renee about taking this job, there were a number of critical things that I thought were important for the business that I saw eye to eye with them on, and frankly, they've been enacted. And the challenger strategy, you will hear me continue to use. It's the right template, the right pillars of the strategy. However, there's some tactics in it that were critically missing and are now very highly visible. First of these, the Metro PCS merger accelerates this strategy. I'm going to lay out for you exactly where it fits and why it's a great enhancement to what we're trying to do. On the network modernization, there was a message in there today that was a new point, and Renee amplified it. Neville's going to cover it. We have significantly accelerated our deployment of LTE. Now, the original plans were to start the rollout of LTE mid-year after we put the clearing of the 1900 band and putting HSPA to 170 million POPs. We've now accelerated that deployment for a number of reasons, and by mid-year we will have 100 million POPs already, and then by the end of the year, a really smoking network of 200, 200, and 225 in the 3 key areas of 4G and LTE, and that's a big deal. The 2 times 10 megahertz in 90% of the top 25 markets, and then at least 2 times 20. And this is something we're going to talk about because it's pinnacle to our overall strategy. The Apple announcement I'll talk about next. It is completely in our financials. I'll talk a little bit about that. But what I'm really going to focus on today is the initiatives that we're undertaking around what I call becoming the Un-carrier. And part of the challenger strategy is to be different, to be bold. And I think we're going to attack a few age-old areas in 2013, and it's going to be a lot of fun, and it's going to be quite different. But let me talk a little bit more about this. This is very important. Now, the good news is we've become an incredible sales machine of the other very competitive devices from Samsung, Windows models, et cetera. Now, what was missing? It's very clear. A certain number of customers wouldn't come to the store if we didn't have the iPhone. And that's not a matter that they will buy it. There was just a definite churn impact, not only on network, but on the iPhone. And we worked very, very hard for a deal that made sense for us. Now, pointing out, the 2013 financials of this business do include the full impact of this rolling out in 2013. This deal is accretive in cash flow and EBITDA in 2014. And I'll actually go a little bit deeper on this because it's not intuitively obvious that the simultaneous execution of one of the other initiatives we're talking about, which is value plans, when you do value plans at the same time that you roll out the iPhone, the EBITDA impact in 2013 is almost neutral. Okay? Now, this is very, very different from what's happened previously and well worth the strategic wait, I think, for the time that we waited. This is not a volume commitment the size of what Sprint agreed to or anything close to it. And I can guarantee you, even though I can't talk about it, when this device rolls out, it will be a dramatically different experience. And I can only tell you that of all the reports that have been written about what's going to happen when it comes out, they're all wrong. And unfortunately, I'm going to have to wait months to point out. But it is different, it is unique, and I'll try to cover bits and pieces of it as we go forward. And it's not because it's not exciting, it's certainly because we're not completely in control. Okay, those are a couple of things. Now, let's go back to the recap, as Renee put in the outline. The recap of what was suggested. Now, clearly, the period of time that this company was waiting for the AT&T transaction to take place prohibited a lot of activity. There was significant impact on brand, significant impact on churn, significant impact on a number of other items. This was also a period of time where the iPhone impact had already been felt. But as you can see, even in that period, the contract data ARPU, smartphone penetration, even contract churn moved very well. And I show you here that the EBITDA margin shows that they were very good stewards of this business. So even in periods of soft revenue and therefore slightly lower free cash flow, the EBITDA margins still, and if you take the first 3 quarters of 2012 as an example, we're generating 29.5% EBITDA margins, and just as a frame of reference, Sprint over that same period is about 15.3%. So we've been good stewards of the business financially while we've been moving through, but we did miss several of the variables here. Good news is a tremendous amount of, I would call it, table setting took place in the Challenger strategy. And some of what's outlined here of what's already done. I won't go through it too much, but I'll just say on the amazing 4G services, to go from where we were at one point with the largest 4G network, introducing the line of smartphones that we did, moving to 10 months now into what Neville's going to talk about in the network modernization, which is not only key for us, it's huge for the merger with Metro PCS. From a value leader standpoint, I'm going to go through in detail a first 2 or 3 of the things that we've done, and then I'm telling you, we're going to break some of the age-old images of what has annoyed customers, especially in the branded contract part of the business. But some of what we've done already has been very innovative in stage setting. From a trusted brand standpoint, we've gone quite a bit of the way in unveiling a new store setup, expanded distribution, multi-segment players. The MVNO strategy is working. The Metro PCS deal is a huge one, and we'll talk about that, and the B2B push has been going strongly. From a Challenger business model, we've done a very good job, I believe, in what we've called reinvent, and we've set the stage for a huge amount of synergies coming up in this transaction. So that's the look back at what's taken place, but more importantly, let's start going through quickly on market trends. You know this better than anybody, but I'll just reinforce that economically right now, this is separate from T-Mobile US, but economically the United States is an attractive market to have an opportunity to invest in. I mean, GDP growth is growing at a significantly different rate. Private consumption is growing at a different rate. US mobile consumption and data consumption, for example, in the last 12-month period, has gone from 568 million megabytes to 1.16 trillion. And you know, the statistics show that over the next 4 years, there's going to be a CAGR of mobile data growth of 66%. So the US market is quite vibrant, and smartphone growth year over year is up about 50%. So it's a very positive market from a standpoint of playing in the wireless space if you can be successful. Now also, subscribers, strangely enough, even in a market that is over 100% penetration, has growth and will continue to grow. And it shows that compared to Western Europe, it's about 4 times. It's a 4% compound annual growth in connections. Now, connections now is going to move also not only into devices, but certainly iPads and e-readers and other devices. And what we're showing here as well is that it is kind of imbalanced in the growth rate between contract and no contract. The no contract space is significantly growing at a 10% compound annual rate, and we think we are uniquely positioned to play aggressively in that space. And I'll talk a bit more about how we've done so far in that piece of the business. So let's start looking about how we reinvigorate the growth. This is a slightly cheaper, not as pretty version of the chart that Renee had, because we're reinventing the business, so we need to cut cost. This is some of the things that have happened already. Now, I will tell you without going through all of them as Renee did, this is hugely important. So the 40 to 45,000 employees that I've got in the company now, I can tell you were dejected. I mean, it was a period of uncertainty coming into the middle of last year, and that's a very difficult spot to be in. The network that we're working through now is greatly enhanced by 6 megahertz of nationwide spectrum from AT&T. This network modernization effort, the Verizon swap with LTE-ready spectrum, as well as allowing better contiguity of our spectrum, the tower transaction, and the Metro PCS combination and the Apple partnership, that's all done. And I can tell you that it's got the employee base of the company jumping out of their chair. So we've got a very excited, invigorated team, which is hugely, hugely important. Now, let's go through the Challenger strategy components, and the first piece of that around network, I'm going to turn to Neville to drive you through.
Thanks, John. Great to be here this afternoon with you and talk through what's a very exciting period of time for transforming the T-Mobile US network. I'd sum it up by saying what a difference a year makes, and it's been a tremendous year of progress. The momentum and the accelerating momentum that John just talked about is really starting to kick into gear, and we look forward to a very, very exciting 2013. Before I jump to the future, I do want to say a few words about the network that we have today. And we have a very strong and competitive network on the 4G side in the US with a large footprint. As John mentioned, that was America's largest 4G network up until recently. The work that we've concluded over the last 2 to 3 years, upgrading our 4G footprint with Ethernet backhaul, then the HSPA upgrades from 21 to 42, have delivered an extremely strong and very, very competitive experience in the US market. The chart here just depicts quickly for you an independent study that was run earlier this year. And it highlights and compares the performance of T-Mobile's HSPA plus 42 network against the LTE networks of Verizon and AT&T and the WiMAX network of Sprint. I would caveat that the WiMAX network of Sprint is about half the footprint of the T-Mobile US 42 network. And you can see there that the speed comparisons on downlink show us in a very favorable light. Actually, across a third of the markets that were tested, we outperformed Verizon. And you can see some of those markets there, big markets such as New York and Chicago, where we outperformed with 42 HSPA+, the LTE version that Verizon has launched with. So, message is we have a big and strong 4G network today, 225 million POPs, and a very large number of markets, all of the major markets in the US. So we start from a position of strength as we look to modernize this network. There are really three. I've talked to, some of you have heard me talk at length about network modernization on multiple occasions, so forgive me if I repeat some brief history here. But there are three key pillars to the network modernization. The first is that we're upgrading our cell sites with state-of-the-art radio electronics. What does this do? It really enhances the performance and coverage and capability of the network. So we're using tower-top electronics. We have the largest global deployment of antenna-integrated radios. So this is where the base station is now moving into the back of the antenna, delivering significant accelerance in terms of deployment, as well as the performance we secure with the tower-top electronics. The second pillar, and both John and Renee have mentioned this, we are introducing HSPA service in the 1900 PCS band. That's where traditionally we have only run and supported GSM services. We are now refarming. We've completed the clearance of that spectrum, and we're now introducing at a rapid rate HSPA into that 1900 PCS spectrum. The third pillar is LTE, and both John and Renee again have talked about our position as we move into 2013, and then the excitement that comes with the Metro combination and what we can do with LTE in the AWS band going forward. Renee has already shown you this slide on the right-hand side here. Just to reiterate a couple of points here. The magenta block is the LTE footprint. And up until today, we've only talked about launching LTE services in the second half of 2013. We're now in a position today where we can talk about half of that 200 million POPs for the end of the year will be available for our customers by mid-year. So we're making strong progress, accelerating rapidly through our deployment on the modernization, and the key benefit there will be an early and aggressive launch of LTE services. At the same time, we've been very busy this year introducing HSPA in the 1900 band. We'll close, the chart shows in the light gray, 100 million POPs of HSPA 1900 coverage by the end of this year. We're going to beat that number markedly too. Today, we're announcing to the market another 3 service areas on top of the 15 that we've already launched. They're in Atlanta, Minneapolis, and Seattle, on top of big markets such as Houston, Washington, D.C., Baltimore, Miami. There's a long list of markets where we have already turned up 1900 HSPA service. And that list will be effectively complete across the major markets by the end of this year and continuing to grow in 2013. So if you look at that ending year position, an extremely strong footprint already in place on HSPA 42 in the AWS band, supplemented by 200 million POPs now of LTE coverage and 200 million POPs of HSPA in 1900. So a very, very different story for T-Mobile, a huge difference year on year from where we were to where we will be at the end of this year and where we will be again at the end of 2013. The next slide just gives you a quick flavor and look at the performance that we're seeing off of some of the early markets that we've modernized. And it's important, I think, to reiterate these early markets, we are seeing great benefits come through from the work we're doing. The chart on the left outlines what happens. The first 2 blocks or sets of bars show the increased traffic that we're seeing in areas of the modernized network. And this is net traffic. So just what we're seeing on modernized, we're normalizing, taking out any general increase in data traffic that we're seeing or voice traffic in those markets. And you can see through the improved coverage, we're seeing approximately 30% more data traffic come onto the network and about 10% more voice. And so the coverage benefits that we've talked about on this program are very real. We're very excited by the performance that we're seeing off these tower-top electronics. And the numbers are showing us that we are going to see the benefits that we've planned and expected to see as part of this modernization effort. Over on the right of that same chart, you see some of the improvements on block calls and drop calls. Drop call rates are great today. They're less than 1%, but you can see they will be improved by approximately 1/3 adding those carriers in PCS 1900, significantly impacting any form of access challenge that customers have on the network. Our access is very good today. It's going to be even better as we continue to light up HSPA 1900. Over on the right is our estimate of what will happen from a coverage improvement, especially on the in-building front, as we complete modernization. And you can see, based on the data we're seeing off the early markets, we forecast a 15 to 20% improvement in in-home coverage, which is a key area. I'll accelerate quickly here. The Metro PCS transaction, hugely exciting. I think what I'd like to reiterate, many of you have seen this slide before, it's the headline. This is not about integrating a CDMA and a GSM-based network. It's about migrating a Metro customer base off of CDMA services and onto the NewCo network, as we call it, one that will provide significant footprint and performance in HSPA and in LTE. If you look at the key enablers on the left-hand side, we have a lot of capacity. I've just talked about it coming online in the T-Mobile network to support that migration. The Metro customer base refreshes very frequently on the handsets, up to about 60%. And so we can look at a very rapid migration of customers over to the NewCo network over a shortened period of time compared to what you might traditionally expect. And on the right, what we look to see is completion of that migration by the middle of 2015, at which point we will start to decommission and turn off the CDMA network. The great piece is both companies have the same vision of the future. Metro has been executing for a number of years now on an LTE strategy. I think just under 2 million, about 1.7 million of the Metro customers today are on LTE. We will be launching LTE services next year, and so there's a great synergy opportunity here afforded by both companies skating to where the puck is going. Okay, the piece that really excites me as a techie guy is the spectrum position. And quickly here, the combination of Metro PCS and T-Mobile affords a very unique combination of spectrum assets in the AWS band. You heard John talk to the fact that we can move from a 2x10 spectrum position in LTE next year to, in 14 and 15, a 2x20 spectrum position, which will be very, very difficult for almost all of our competitors to match in the US marketplace. Some just simply cannot get there in the time frames that we are talking about. We're coming through with LTE in release 10. It will be highly performing. We can double speeds. This network is going to pack a significant punch at a critical time in the US marketplace, one that I think will be the envy of our competition. The last slide from me before I hand back to John. There are some great assets within this Metro network that we look to leverage on a go-forward basis. And I'll highlight one is the DAS networks. There's a small tutorial on the left-hand side of the slide here about what a DAS is, distributed antenna system. But bottom line, Metro has done a tremendous job of building out spectrum density and reuse using DAS systems in key urban areas of the US. We will look to leverage that, upgrade those sections of the network to support more LTE and to support HSPA so that we can ensure that those Metro customers never miss a beat in terms of the experience and performance that they see from the NewCo network. We will look to decommission about 10,000 of the macro sites that come along with the Metro network. About 1,000 we will keep. But the 10,000 decommissioned are a key driver of the synergy numbers that you heard John and Renee talk to earlier on. With that, I'll hand back to you, John.
Okay, it's a tough audience, by the way. It's the most I've ever behaved in my life. Couple of things to capture as we move forward. One is all the growing pains of getting this huge modernization and transformation process going are done. It took a while to ramp up. It's at full speed, so we will hit those targets, and as we've said, accelerate them. This is fundamental to the change of this company. And as you know, the various qualities of network performance was probably my biggest churn variable. And in the plans that we put forward, a big portion of the 70 basis point churn improvement that I'm expecting over time in the contract space is coming from network quality improvement. This also, as you can see, as we get this realm of HSPA and LTE capabilities, as devices over time find the ability to search for the highest quality network capability, we're going to have an incredibly superior experience because most of the other players may have one good quality network but fall back to an inferior capability. whereas our spectrum of capability is going to be extremely exciting. And I think you'll hear us target very aggressively Sprint. We're not going to target Sprint. We find them easy from a network standpoint. We're going to very aggressively target AT&T, and I'll talk why. And significantly, there's some huge perception changes that have already taken in the category called AT&T switchers. Second point I want to make sure you capture is we've talked about the impact of the Apple deal. We've talked about the cost associated with the network transformation. And I inferred about the value plan impact to our financials. I want to make sure you understand that those are 100% baked in to what we're talking about in the Metro PCS NewCo. So there's no secondary adjustment that's needed. And as I'm talking now, recently when we were talking about NewCo, some of these variables we weren't able to share. And piece by piece, I think it's becoming hopefully clearer why we're so confident in some of the NewCo growth. Now, this is the fun part for me. I'm going to talk about value leader and trusted brand together because this is fundamentally going to be the area where we innovate. And we're going to innovate on a few things. Innovative value plans, which I'm going to talk to you about because that changes things. Amazingly affordable hero devices. We are going to get devices into the market, including this one, at a price that beats the rest of the industry. And we'll talk some about that. And we're going to talk about customer experience in a little bit different way than Renee did, and this Un-carrier brand. And stay with me for a second, because you're all customers as well. And what we're finding as a challenger is right now, customers are really still pissed off at very unpredictable billing, very unclear pricing, restrictive and confusing upgrades, and unfair treatment of loyal customers, and this whole way that we sell them a phone and bury the costs into a long-term contract and tie them in. We think there is huge room for a challenger to change some of that in a way that the larger players will not be able to or will choose not to respond to. So let me talk a little bit about a few of those. Now, we've launched a few things that each by themselves may not seem groundbreaking, but I'm going to start to pull them together for you. First, value plans. Now, a value plan is in effect separating the device from the rate plan. And what it means is that if a customer wants to come in and they're happy with their own device, they can walk in the door, bring their own device, and use our network capabilities. Customers that want to come in and buy a device, they want it low upfront out-of-pocket cost, they can finance it. Very low upfront, we can provide equipment installment program, and it's a very low, very clear out-of-pocket price, and then an incredibly low rate plan that together are still much lower than the out-of-pocket cost for the traditional contract businesses. Customers can upgrade at any time, and that's one of the variables that customers are going to really love. Now, by the way, we've tested this. 80% of the activations in our stores right now are on value plans. 12 to 15% are bring your own device. We have 1.7 million iPhones that have already come into our business. So the bring your own device, which is fully made come to life with the value plan, is with trade-in options. Okay, so this is changing. This is a little bit more like the way an iPad sold, or the way you buy a television before you buy your cable TV. And to customers, especially when we can keep the money out of your pocket lower, they're going to be able to see visibly and transparently what used to be most confusing. When you listen to customer calls, they really don't get that $99 phone wasn't really $99, that it's baked into being stuck for 2 years, and they want to upgrade whenever they want. Now, there's a couple of things, and the other thing that we introduced was unlimited 4G, real unlimited 4G. And I can tell you, some of the new devices that are out there, customers are already pulling down, 3 gigs of traffic and growing. So this is a big deal. These metered plans that used to sound nice at 2 are not nice. Young people really don't like it. So as the network quality goes up and the bring your own device, good smartphones on a quality network, there's something big here that we're going to talk about. Now, we are moving, and this is news, we're moving 100% to value plans in 2013. Not yet. And what's the value proposition? Fair and simple pricing, low out-of-pocket expenses, equipment installation plan. You want to buy one of the top-of-the-line devices, you can come in based on credit capabilities. You may pay $99 for the most iconic device in the world, and then you may get 20 months worth of, call it $15, $20 a month. So it's very cheap out of pocket, it's very low. At any point in time you want to come back and trade in that phone, we will give you residual value, let you trade in the phone, stay on the contract services that you have. There's a lot of capability in it for us. We are able to refurbish those devices. We've got a capability that we can do it lower. We can use those devices in a secondary capability instead of warranty products. And we can actually make a margin on the whole EIP process that takes this capability to market. Now, a couple of statistics I'll just tell you as well. We also believe it's going to have significantly better churn. It's going to have a lower device subsidy, obviously, and overall value. So what we've seen so far is that there's a 2-month longer customer life for our customers that are value plan versus classic plan. And if you look at the ARPUs, we get about $58.90 ARPU on a classic plan, about $43.90 for a value plan. So there's definitely a lower price. Margins, 46 classic, 33 on the value plan. However, device margin, $200 to $250, which we do not have to eat. And what you end up having over a 24-month period, or the customer life, 2 months longer customer life, and a customer life value that is the difference between $550 on a classic plan and $600 on a value plan. Now, this also, of course, will have in year one a very positive EBITDA impact because of the recognition of the equipment revenue up front. So this is a big deal, and it's step one of the kind of things that we're going to do to disrupt the industry. And trust me, the way we will roll this out in the unshackling and the lack of being attached and the ability to constantly upgrade devices and to see exactly what you're being charged is going to be a big deal for customers and a big deal for brand and a tough one for people to respond to. Let's keep moving. So best smartphones at lowest out-of-pocket prices. Now, just a little bit of data for us so far. Smartphone sales up Q3 about 28%. We've gone from 44 to 57% of our base in smartphones. By the way, average data usage on our smartphones is up 30%. And 77% of the units that we've sold in the US are smartphones. So with this value plan and the push towards smartphones, this is a continuous, if we believe cheaper smartphones, lower out-of-pocket cost, a very smoking fast network and flexibility is going to be the formula for success. Now, customer experience. We slipped a bit here. For about 9 years, up until 2009, T-Mobile US was the J.D. Power's #1 customer service experience company in the United States. We're not right now. In fact, we're 3rd or 4th, and usually 4th right now. But for some very specific reasons, one was the morale of the company, but secondly, certain things that we did to remove the authority and the accountability of the people in the customer service centers, and some changes that we're making policy-wise to focus on allowing the best customer experience, investing in systems between the stores and the call centers, consistency of policies, et cetera. Already in the past 2 months, we've seen a big surge in what we call voice of the customer. So I will tell you that my #1 focus as the CEO has been on care. I listen to about an hour's worth of calls every day. I take all customer-related escalations personally and reply to them. And it's given me a bond with the service organization, and I can tell you that in the time required in the next 6 to 12 months, we will retain our leadership in the J.D. Power's assessment of top customer service and customer experience, because it's extremely important to us. A couple of statistics there. Calls per customer to care, which is very important, are down 13%. Drop calls down 10%, handset exchanges down, and we'll continue to work these issues as well. Resulting, all of these things, in this ongoing churn improvement. So, the full range of onboarding, recontracting, smart rate plan migration, et cetera, has caused a year-over-year improvement, including in Q3, churn was down 30 basis points. What you can expect here from us is continued churn improvement. Now, Q4 of 2011, churn was about 3%. That was the height of our competitive period. We are facing the iPhone in Q4, but we will significantly outperform last year's churn and continue a trend of being on this front. And if you look ahead, the plan is to finish 2013 under 2, call it 1.98, and then in successive years go down below 1.9, below 1.8, and by 2016 get down to 1.7. And that's one of the biggest variables in our success in the contract side. Now, aggressively reestablishing a brand. If you've been in the US, you may have noticed a significant surge in our brand advertising. And in phase one, we focused very heavily on network coverage, network quality, and of course the 4G, monthly 4G and unlimited 4G services. This has been on purpose. It's a fascinating change. So we're improving the network, but we're spending tremendous amounts of money telling people we're improved the network. And what's fascinating is for T-Mobile, the perception of the network was less than the network quality, which was lower than the acceptable level. Already what we've seen is customer satisfaction on coverage up 10%, customer perception of network dependability up 12%, and consideration is up 10%. Now, that was phase one. Phase two, you've seen a little of, and that's the shift away from the nice girl advertising and the kind of nice guy to more edgy, more of a cool, uncarrier, and we're going to play with that aggressively, especially as we announce very innovative changes. So it's a little bit more memorable and cool. Phase three, which will be compelling offers and reasons to buy. And we've done trials with this. On the couple of days, the week before Thanksgiving, we put out an aggressive campaign, and store traffic was through the roof. We actually had almost a 70% year-over-year traffic increase on the Friday that we launched this. And so we can move the needle. We've got some things to do. Here's a couple of numbers I want you to know, though. We track AT&T switchers. These are customers of AT&T's that are likely to switch. And we've had a perception of coverage up 15%, tech leadership up 20%, and affordability up 22%. So if you're an AT&T switcher right now, your perception of us on affordability is 56 versus 40 for AT&T. On coverage, we're believed the perception is 48 versus AT&T's 40. So as I said, when we get this network capability, especially in the key cities with the 2x20, AT&T is very vulnerable to this coverage and quality. And the core of what we're going to play with here is you love your iPhone, you hate AT&T, and we've got an intersection for you. And I want you to get used to that tone, because that is the way we're going to play. I just put this next chart because, and I'm not trying to be cute with you, this isn't a teasing, but as we get into the early spring, call it March, April, especially as we announce our deal closure with Metro PCS, we get ourselves positioned with various other variables and some of these other plans that go along with and possibly after the 100% value plans will be a launch of a very visible, significant, in-your-face campaign that attacks right into this space. So it's going to be a very, very fun period for us. And you can fill in the blanks. I would fill them in for you. But big campaign, new campaign, and if you think about 100% value, multiply times 3, 4 or 5 other things that I hope get customers to say, I can't believe they did that. And that's going to be how we play this game. I'm going to rush up here. Multi-segment player, couple of things that are very important here. One, no contract. Just talking mostly about our business here before the unbelievable opportunity we have. By the way, we are the #1 player in the no contract space. T-Mobile had 13.5% share of gross ads and put us in the #1 leadership position. We actually had 365,000 positive net ads in Q3, which, as you saw, was a big percentage of what the industry was. And for the year, we have 23% increase in subscribers, 38%, and we're targeting 25% growth in 2013. The ARPU for us is about $27 and going to about $30. So this is a good business. We'll talk about Metro in a second, because the big deal for us is Metro is a highly successful player in this space with a $40 average revenue per user and a unique go-to-market approach, a very successful company with only 105 million POPs covered. You saw the network capability that we have, and on day one, Metro PCS customers are going to go onto that network. So their coverage expands, their customers can have international roaming, a much broader network, and a wider set of handset choices. And we have shown in our deal that we believe we can grow at that industry growth rate. And we've only shown in 2017 $300 million worth of incremental revenue from taking PCS to select additional markets, Seattle, Minneapolis, New Orleans. That, I believe, is a significant understatement of where we're going and the size of the potential opportunity. So there's a big possible upside as it relates to that piece of the business. MVNO, another piece of the business growing very well. It's growing about 10% compound annual. We've got about 11% in subscribers, 15% in revenues. ARPUs here are $11 to $12. You have to be very careful with your cost and where you deploy these. And we're targeting 20 to 25% subscriber growth in 2013. Business side, very aggressive. 1,000 incremental salespeople that we're well underway in adding. B2B presence in the retail. These are some of the customers. We grew 5% last year. We're going to grow about 8 to 10%. We have 5% share of a $65 billion market. 1 to 2% share growth is about $1.2 billion. We're looking to go to 7.5% share over the planning period. Noting some of the offers there, what I won't take you through, but this is a great opportunity for us. We get the question all the time, do you really think you can compete with AT&T and Verizon on this? The answer is no, no desire to. Small and medium, mid-sized customers that feel abandoned in very select areas with international requirements and only looking to go to call it 6 to 7 to 8% market share and do it in a way that they'll have a very difficult time responding. Challenger business model. We're very good managers of the profitability of the business. The reInvent program at T-Mobile has delivered $900 million incremental in 2012. We will continue to reinvent. It looks like we pushed $300 million of that back into the business last year. Incremental reinvent for next year, $500 million, then $350, then $100. I think one of the things Braxton and I agree on, there's a lot more to do here. In addition to the economies from the synergies of bringing the companies together and the network synergies, which are on top here, one of the things we're going to do as soon as we're able to is really look hard at this bottom box, because T-Mobile woke up a big company. And there are going to be a lot of better ways, I think, and one of the things I've got a lot of experience in is finding cost. So stay tuned on that box, but there's an awful lot of business model enhancement that we can make. With that, I'll turn over, and you'll get to ignore that 1 minute. We get a few extra ones.
Well, thank you, John. I really appreciate it. It's a pleasure to be here. I'd first like to start by saying that we're very excited about the combination of T-Mobile US and Metro PCS. It is undoubtedly going to create the preeminent multi-segment value leader in the U.S. wireless market. We're very excited about that. $6 to $7 billion worth of synergies. We think there is upside to that. And on the techie side, Neville was talking about the 20 by 20 LTE path. That is going to be absolutely critical in the future to maintaining cost leadership. There's significant advantages of that configuration, and we're very excited about what that's going to do for the combined company. Now on to the 2013 guidance. I want to reiterate that this includes all of the initiatives that John and Neville have talked about in this presentation, and most significantly includes the full impact of the Apple products that will be in the lineup during 2013. Also, I want to reiterate that 2014 on, the full impact of Apple will be accretive to EBITDA and to free cash flow. These are US GAAP numbers on a pro forma basis for the combination of T-Mobile US and MetroPCS. It includes all synergies, and importantly, in 2013, it includes the cost to achieve those synergies. Service revenues, $20.8 billion to $21 billion. EBITDA, $5.8 billion to $6 billion. EBITDA margin as a percent of service revenue will be 27 to 29%. Cash CapEx will be $4.7 billion to $4.8 billion. And remember, this is a year of investment. There are significant costs to achieve embedded in this 2013 CapEx guidance. Neville talked about upgrading the DAS systems to support expanded LTE and HESPA Plus. That is a significant one-time investment that's included in 2013. So 2013 being a year of investment, we are also investing in working capital. The impact will be an additional $300 to $600 million. This is a net number. We're looking for multiple opportunities to increase our cash flows and reduce working capital needs. One very important initiative that T-Mobile USA has instituted is a program to change from billing in arrears to billing during the month the service is provided. We're very excited about that opportunity. Ambition. These are the ambition numbers that we laid out when we announced the transaction in October. They're 5-year CAGRs. Revenue, 3 to 5%. We're highly confident that we can achieve this. And let's go through some of the aspects of that. First of all, contract. As John talked about, 2013 will be a year of stabilization. Given the significant investment in network modernization, given the introduction of Apple products, we are highly confident that we can achieve this objective over the 5-year period. EBITDA, 7 to 10%. Increased scale, the challenger strategy, driving costs out of the business, and really running this business to create EBITDA and EBITDA margins and create shareholder value is what this is all about. Free cash flow will increase 15 to 20%, and we're looking at a targeted profitability level at the end of the 5-year period between 34 to 36%. Going back to the growth story, we talked about the contract part of the business stabilizing in 2013. There's very, very modest growth projected for the remaining period. There is some growth, but given the saturation in the market and given what John talked about, the growth opportunity really is in the no contract space. The CAGRs that's projected to grow far outstrip what's happening in the contract area. And we believe really being the value leader that we can take increased share from the other players in the market's contract offerings. The non-contract offers will be 80 to 90% of the growth. We will also have focused expansion of the MetroPCS brand. And this is where we've been very conservative. What's embedded in these numbers are expansion only to 6 to 7 million additional POPs. There's 3 markets in the US, major markets, that don't have a MetroPCS type model deployed in them. Seattle, Minneapolis, and New Orleans. We have included that, but we think the opportunity is much more significant. We think there's an opportunity to expand up to 100 million additional POPs. And what's exciting about this expansion is we're leveraging the T-Mobile assets that are already in place. So there's going to be a much different return profile, a very rapid path to EBITDA break even, and what we're looking at in a very short time period, 2 to 3 years, is EBITDA margins approaching 50%. I want to spend a few minutes talking about where we stand on closure of the deal. We continue to expect closing in the first half of 2013. The regulatory process is going very well. The FCC, we are on track. We expect approval by the expiration of the FCC's self-imposed 180-day clock, which is April 24th, 2013. The DOJ, we did get a second request that was fully expected. This combination is highly pro-competitive. We don't expect any significant issues with the DOJ. CFIUS, the wonderful thing about our transaction is DT has already been fully through the process with their 100% ownership in T-Mobile US. This transaction actually decreases that ownership. We expect no issues there. SEC, we filed the proxy on November 16th. The SEC is in the process of reviewing that. What's unknown at this point is how long that review process is going to take. Once the proxy goes effective, which includes fully SX-compliant financials for MetroPCS, for T-Mobile USA, and more importantly, the pro forma financials of the combined company with the purchase price adjustments. When that goes effective, there's a 20-day requirement in the state of Delaware where MetroPCS is incorporated, and that's 20 business days to give notification to the shareholders to hold the shareholder vote. So practically speaking, you're going to be about 30 days after that proxy goes effective. At this point, we anticipate best case being able to mail the proxy to the shareholders in the February timeframe. It could go past March 1st. It's just really an unknown at this point. One of the things that I've been really impressed with is the compatibility of the cultures between T-Mobile USA and MetroPCS. And where this is highly evident is what's happening in the integration planning process, which is going on. The teams are fully formed. They're very enthusiastic. By the middle of December, we're going to have high-level plans completed, and we're well on the path of executing to the critical items that have been identified for day one of close. So in summary, again, it's a pleasure to be here. I'd now like to turn it back over to John.
And we're well over time. I'm not sure I like this process where you can't ask questions till tomorrow, but it was fun this one time, I have to admit. If we could select who could ask questions and who couldn't, it'd even be more fun. Summary. Now, I won't read the points here, but there's some things that I just want you to take away. We are closing this deal, and we are way down the path. So in spite of what you read every day, this deal is closing, and we are way down the path on integrating these companies and understanding how to do it. So we're waiting for no one, and that's very exciting. We are going to launch Apple products, and we're going to do it in a very innovative way and very exciting. And trust me, when we do announce what we're going to deploy, it will clearly be better and more effective than any of the geniuses that have been writing in the last few days. It just makes it that much more fun when people speculate so wrong, because it's going to be one of those retractions. The network deployment is happening. We are testing products on this new network, and it's smoking fast. I mean, when you start to see 45 megabit downloads and 25 uploads, you see some of these capabilities, and you know you're going to have them in an unchoked manner. It's very exciting. So that's got to happen. This deployment of innovative services, this all value, and then trust me, we've got 3 or 4 more that are coming, and then a customer service experience that matches it, the churn issues to network on, but then a brand and an employee base that is the Un-carrier with attitude and a fighting mechanism, both in how we brand and how we sell and how we present ourselves. will be a little bit like a Davy and Goliath, and it's going to be really, really fun because remember, for us to be highly successful, we need to integrate this company and we need to gain a certain amount of share. And it'll be really fun to see how they're going to respond when everything we're doing is going to be to cure big pain points that customers can't stand. And finally, we've got a full bag of weapons. No distractions, no missing devices, no inferior network. Good leadership team. I think it's going to be a lot of fun. So I really appreciate your time today.